Hey everybody, Ben Hart here. It's 4:15 on April 21st. Beautiful spring day out there. We've had kind of the classic Canadian season where last weekend we had summer, and then on Wednesday this week we had winter. Now we get spring again for a couple of days. So hope everyone's enjoying that, and a lot of snowbirds coming back to Canada. So welcome back, welcome home. Lots to cover today. I have a bunch of slides to go through, just really kind of my take on where we are. It was an interesting week this week. We had Hedgeye always does an investment summit this time of year. It's all virtual. So some great speakers there, which I'll comment on a little bit. Stephanie Pomboy, David Rosenberg, and some others that Lynn Alden that were excellent. So I've included the link in the presentation as well for anyone that's interested in having a look at that. But I'll take you through my view on what's going on, what happens this week, where I think things move from here, and what comes next. So I think probably first of all, I'll jump straight into the presentation. Then at the end, I'll talk a little bit just about where we are from a reporting perspective, tax-wise, and a few other things. So I will jump into the presentation now. All right. All right. So we will, looks like, I think everyone can see that. Looks all clear on my screen. Lots to cover. Did a number of presentations this week. Have a few banking partners where I check in with them monthly. They're interested in seeing what's happening with the economy and such. So this was a great piece from Manulife this week. And so Manulife put out a great chart deck, something like 90 pages just on their view of what's happening in the economy, what's happening in the bond market and the and equities and such. So some great stuff there. But some of you might remember my presentation from January of 2019. Manulife had put out a great chart similar to this at that time. And looking backwards, obviously, we had a bit of a contraction in the economy then. And so as we look at their view on, these are their top 8, top 7 things around what is important around whether we're in a recession or not. So inverted yield curve, obviously, we've had an inverted yield curve for just over a year now, I think about 15 months. So if we look back historically, 12 to 18 months is the inverted yield curve before it effectively shows that we're in a recession. However, in a recession, you're only going to know that looking backwards, but certainly inverted yield curve is a condition necessary to be in a recession. ISM, we've talked a little bit about the ISM, and it's really a gauge for how the economy is doing. ISM above 50 is expanding, below 50 is contracting. And so across most major economies, we're currently hovering around 50 plus or minus, but certainly the majority are in a contractionary phase, with the exception of China as the major economy that's around 52, 53 PMI presently, or ISM, excuse me. Positive inflationary trends, I mean, that's an oxymoron because that means that inflation's slowing. So yes, that's happening. Tighter financial conditions, 100%. We know that's the case. It says neutral, but financial conditions have tightened at the fastest pace in history. Housing starts declining. Again, we're seeing a rate of change deceleration there as well. Labor market weakening, no, and leading economic indicators negative, yes. And so again, labor market is a lagging indicator. And so I think that the data more for how to read the markets and what's happening in them are leading indicators. Laggings don't matter as much. And so labor market, one of the things that's come out in a lot of the quarterly reports, and there's only about 100 of the S&P 500 reported so far, is that almost every company is either warning that they're cutting jobs or are in fact cutting jobs. And so that's showing a deterioration in the labor market. This is the National Bank Financial's view on the economic reading indicators. And so if we look at these here, you can look at the direction again. Certainly an increase in reds on a week over week basis. So as I was listening to David Rosenberg this week, if anyone wants to listen to the whole interview, it's about an hour and certainly worthwhile. And from an economic perspective, is one of the best minds. And so one of the things that he said at the time through this presentation is he talked about a guy by the name of Chuck Friedman, who used to work for the Bank of Canada. I think he was vice chair of the Bank of Canada. And so Rosenberg had asked, what's kind of that one leading indicator that you use to gauge what's happening in the economy? And this was the one that they use most frequently, is what's the small business optimism. And so obviously we're seeing a super slowdown in small business optimism. If we look at these other major periods since the mid 80s, so 40 years or so, as we drop around this dotted line, that's when we tend to get trouble in the economy. And so if we look at what that means, this is what it means to small business. And small business really is the lifeblood for from the US economy. And so if we look at what this is saying to you here, this is showing that it's getting much more difficult for small business to get access to capital. And so it's a chicken and the egg. What's happening first? Is small business optimism slowing, or is it tightening that's causing them to slow? Overall, this is a negative for where we are in the economic cycle. And what does that mean for stocks and bonds? We'll talk about that as we go. But from an economic cycle perspective, that's what we're seeing. And so just as we look at, I've talked over the years, for those of you that join me for these and my annual and semi-annual presentations, I talk a lot about the rate of change matters. And so as we have conversations, and I continue to have conversations with people about inflation, what's happening in an inflation perspective, this is one of the key drivers of inflation over the past 12 months is now a detractor. And so if we look at the rate of change and these lower highs, this is effectively what we're seeing with oil. And we saw OPEC reduce output last week. And so, we saw a bump and now a correction, of course. And what we're seeing as well as the Canadian dollar weaken on the back of that. And just to further discuss really what's happening in the employment picture, I've talked a little bit the last couple of meetings just about what's happening with employment. And I said, I don't think we see the big spike in unemployment that we've seen historically. And I think that's the case from a number of reasons. Demographics, certainly one of them, but also from the effects of people working multiple jobs and such. I think overall changed that narrative a little bit. However, if we look at the data, and again, this is the data, number of employees, this number rate of change is slowing very quickly. And the average work week, again, this has gone negative, and this is from a pretty significant high level of last year. And so we've seen that move into that negative camp. And, ultimately, it is kind of ugly on the surface, but ultimately what the central banks want to see. It's kind of the last thing they've been holding off on with their tightening cycle. I think they do raise rates again next month, even though they don't need to. But it seems like there's this ever-present push for Powell and company to continue to push that rate up. And the economy is telling them something otherwise. But on the back of this, there'll be a pause and then certainly a cut. And additionally, through that presentation with Rosenberg, he even said, look at, the further and the higher the U.S. central bank goes from a tightening perspective, the faster and the lower that they're going to do from a cutting. He said you wouldn't be surprised to see zero bound again in rates. So I know it's hard to believe today where we sit, but if that narrative plays out, then you get a massive rally in bonds on the back of that, and gold as well. So interesting take. Great chart here from MFS Global. And so if we look at policy tightening, and so, if we look around the world, Turkey, UK, Sweden, Australia, New Zealand, we go Canada, US. And so if we look at where we are versus where we're going, for the most part, most of these major countries have either gone into pause, which is what the Bank of Canada has, or are in the final strokes of their rate increases. And so ultimately, at some point when they cut quite drastically. But right now we're progressing into that pause phase. And so we got kind of a sideways movement to markets, particularly bond markets, over the last, I'd say, 2-3 weeks. And so continue to watch this, but it looks like their hiking cycles generally are behind us. So we look at what this looks like from a forward curve perspective. this is this is a smoothing of what happens as rates come down slowly into the next part of the cycle. And before the economy contracts, this is typically what we see. But what actually happens, which you will have seen in the daily that I did today, is that when rates get cut, they get cut very quickly. Not in this smooth progression, but ultimately bond markets pricing rates to come down slowly. And so if we look at what happens during a recession, we can look at this over a long period of time here, almost 50 years, is that we've seen when we do go into a recession, you get a material rally in bonds. And so when I think about that, and I've been talking about that for 6-9 months now, is that we want to have some duration. We want to have exposure to bonds. And I say duration, we want bonds that have a timeline greater than 5 years at the present time with my view. So we want to have exposure to the kind of that longer end, because when rates come down, the prices of those bonds go up, and they go up quite quickly in that backdrop. And historically, that's what's happened. So I continue to stay with that view that the economy continues to slow, and I want to be positioned for that, which is make money in bonds on that side, as well as US dollars. This is a great just kind of snapshot of a view, and I know this is over kind of a longer time frame, so it doesn't look super dramatic, but we've seen the kind of the fastest increase that we've seen at least since the early 2000s, and from a debt service ratio by Canadians. And so this is going to continue to put pressure on the economy in Canada, and the one of the major reasons why I think that the Bank of Canada is on hold and ultimately going to cut as things slow faster than expected. So I put this up last week, and again, I just want to point to a couple of things, and it's just really positioning. And so as we looked at this last year or last week, for those that were with me, this is just the view of how speculators have exposure to different asset classes. And so a couple of things that jump out is the US 10-year maturity bond is presently here, where this was last week's, and then if we look at this week, it's gotten even more short. So the speculators have been going more short the 10-year bond, and so I believe that there's a huge move when the economic numbers continue to slow, and that trend starts to move in the other direction, and that's when you could see this kind of ball underwater perspective, where you get a pretty big rally over short periods of time, week, 2 weeks, that I think it makes sense to have exposure to, where you can get a 4% income payment plus a potential for, I think, 15 to 20+% returns over that time frame. The other thing that I pointed out last week was just the Canada versus US. And so I said, we got a big short position in Canadian dollars versus US, or sorry, US versus Canadian, and the likelihood was that the Canadian dollar is going to go down versus the US this week, and that's how it's played out. But there's still, again, if we look at positioning, Canada and minus 60,000 contracts, and we finished the week at minus 57, so really close to those levels. As I mentioned, the US dollar went up versus Canadian this week, and finishing up about today, the US dollar is up about half a percent versus the Canadian dollar, which is a pretty big move in currency land. So last couple of two more slides, and then I'll let you go for your weekend. Certainly, if anyone has any questions as well, you can pop them into the question period there. But if we look at how bonds have performed since the middle of the 70s, so this is a 50-year cycle, and so when we saw the material sell-off that we saw in bonds last year, just to give you a gauge of how material that was and what has happened historically when you get a correction in bonds. And so there's only a couple of periods where we've seen a bit of a dip in bonds, and that was in kind of the mid 90s. That was mostly around the savings and loan crisis, so that was a different event, but certainly something to be conscious of. You got a massive rally in bonds in the preceding, well, certainly 1 year, but the 4 years after that, again, similar period, 2008. Coming into 2008, we saw a correction. Then we had a big couple of years, and then 2013 where Bernanke went into his changing direction, and so we saw bonds rally for 4 or 5 years in a row, and then huge correction in the last 18 months. So my view is we get that kind of mean reversion. How big is it going to be? It's really going to depend on how deep the recession is. And so continue to watch this and think you want to certainly continue to have exposure to bonds and high quality ones, not high yield, high quality government bonds in your portfolio. So last two, this is just housing market versus stock market. Certainly the housing market has returned quite consistently in Canada, but ultimately equities continue to outperform housing with a lot more volatility, of course, because you can price it every day. But I thought it's an interesting look at how that plays out. So the last piece before I take any questions and give a couple comments on taxes. And so I'll send this out as per usual. And I listened into these great presentations. So if anyone wants to dig in, hear a little bit more about what David Rosenberg has to think, or Stephanie Pomboy, or Lynn Alden. Lynn talks a little bit about just where the world's at, talks a little bit about crypto and Bitcoin. So certainly very interesting framework she has. So anyone wants to listen to that, it's worthwhile, it's free, and you can dial into it at any point. Well, that's great. Thanks everybody for joining me. It's 4:30 now. We continue to send out tax information. If there is something that you need or your accountant needs, certainly let us know. We'll send it along. We've had that continues to come our way. Starting next Friday, new associate joins, Renaud, and we'll have more information to share about her once she's officially here. I'll send some details along. She'll join us on one of these calls. I'm not going to make her join on her first day next week, but certainly look forward to having Renaud join the team, and she'll be on to help support administration, book meetings, those kinds of things. So look forward to introducing her to all of you, and hope everyone enjoys their weekend. Any questions anyone has for me, certainly feel free to send them along. But as always, appreciate you dialing in, and have a great weekend.